Everyone. Today we're going to be taking a look at a very interesting scenario, and this is usually something that doesn't get brought up a lot because we just don't get these cases that often, and that is going to be a calendar spread trade discussion regarding an earnings trade. And for this example, we are going to be using ticker symbol KMX, that is CarMax. Now, before we go further with this, guys, I want to make note of this. This is more or less a example. Now, could there be something here? Absolutely. Otherwise, I won't be bringing it to you. But this is more for learning purposes here. So we're just going to go through how we look for these types of names. What's the scenario? What's the setup? Why would we trade a calendar instead of selling straddles, right? And a brief overview of what the position looks like, how to manage it, how to mitigate it, and a little fundamental analysis, obviously, on CarMax and what is going on, why we're seeing these lucrative numbers, as we can see with the implied versus average, implied and the implied versus average move. So let's get right into it with that out of the way. All right, so first, let's go over the numbers. Implied move, obviously 10.5, great numbers, right? Average move around 7.9. This gives us a ratio of around 1.35. Great numbers, love to see it. Implied versus average implied, great, love to see it at 1.446. There is a problem though, right? Remember, we don't get paid for this. We get paid for this, and this isn't good. Drop performance of 96% is not something that we want to be doing. And as we can see, if we come down here, we notice that this is really more or less due to blowouts, right? Massive loss, 113% loss here, at 92% loss here. But if we also notice that there's some really big payers here. Like this drought performance last quarter was 54% return if you sold, 35% here. Further back in the day, we saw 40, 60%. Basically, there's been like a trend where it's like pretty sizable underperformance, like almost pancake territory, or complete blowout, right? Like a 25% blowout. So, with that being said, we have high implied move, lots and lots of gamma loaded up on those earnings. There's an opportunity that we could sell this, right? But we don't want to completely lose our whole bankroll, so to speak, with an event like this. So how could we mitigate that a little bit, right? Where if we have a stock on earnings that typically is pancaking, right? Recently been pancaking a little bit more or blowing out, what can we do? Well, this is where the calendar comes into play. So what exactly is a calendar spread? Well, a calendar spread is pretty much just this right here. Okay, let's get this up. You're going to see that a calendar spread is essentially selling the front, so the 10s, and buying the back, like the 30s. So you're selling vol at 103 and buying vol at around 67. That is essentially what I am getting at with this particular calendar spread. So why would we do this? Well, here's the thing, guys. Let's go to Thinkorswim now. Actually, a little bit earlier than usual. You're going to notice that you're paying a debit, right? This is going to cost us 128 bucks up front. And think about it. It makes sense, right? We're selling a vanilla option and buying the exact same vanilla option just with term, right? So this is updated right here. These volatility levels are actually updated to what our forecasts are. The non-event implied volatility for the 10 and the non-event implied volatility for the 30-day. Now, obviously, it's going to be a little bit different because we're talking about May options here. We're talking about April options. So it's a little finicky in terms of the dates. It's not like a perfect 10/30. It's more like an 8 in terms of just vanilla days and then around 40, 45. Nevertheless, it's a pretty decent approximation. And what you're going to see is you're risking 128 bucks right now. And if we get a pancake, you're going to almost double up, right? And well, you would make a really profitable return if we got a pancake on CarMax next week. If you just sold straddles, I don't know if it's going to be near an 80% return. Most likely not because you still have 3 more days in the trading session. There's still that risk of, just drift and commonalities and things of that nature. So that's just a review of the trade. Managing these positions, it's pretty simple. I mean, it's the same thing like a straddle. You put this on right before the close and you take it off in the open. If your view is just the earnings event. Now, if your view is, go back to the PA terminal real quick. If your view is that, hey, looking at the relative value, we can see the non-event IV10 to the non-event IV30 is in the top 8% of its usual trading range. This could be overpriced too. By all means, this could be something that you hold on to after. It's really all your own view. But your confidence interval, right? The level of confidence that you need to be is probably not as high because you don't need to risk as much capital here to get significant exposure on a P&L percentage basis. So that is the general gist. If you guys have any questions with that, by all means, please let me know with any questions that you might have. So now let's just break down CarMax real quick. So CarMax, why is this here? Why are we seeing higher levels of implied move for this particular quarter? Well, guys, it's pretty much stemming from a couple of things. One, the qualitative, obviously, people are afraid. Investors are scared. If you know or if you're familiar with what's been going on with Carvana, they've gotten completely obliterated, having to, issue debt, issue equity. They're all over the place. And a lot of that is starting to trail over, at least investors think they might be trailing over into a name like CarMax. And obviously, used car sales have been terrible. I mean, we've actually been seeing in a period of really high inflation, used car prices continuing to get peppered and peppered and peppered and peppered and peppered. They're actually in a deflationary state right now. So with all that being said, we're actually seeing some of the lowest earnings estimates for CarMax over the past year. That being said, I think that this is why we're seeing a level of a high implied move. Because if we come back here, as the last thing I'm going to tie this into a bow, is if you go to the put P&Ls, you're going to see that this is ridiculous. I mean, this is like insanity, right? This is nuts. This is pretty much alpha generating every single quarter since basically 2019. It's ridiculous. So with all of that, I think that since, that volatility spike is usually to the downside is indicated here, these long lags down, right? So terrible Calamar ratios. This could lead to why we are seeing a higher level of implied move because the overall thesis is bearish. So that is all I have for this one. That is also why in this example, I should have made note of this. That is also why in this example, CarMax is trading at $64. That's why this calendar is at $60 to mitigate deltas a little bit. That's my own personal view. If you have a different view, by all means, do what you think is best. If you guys have any questions, again, feel free to message me on any of this in earnings discussion, or if you want to message me privately, go ahead. And I will see you guys in the next one. Peace.